Yeah, there are annuities that can do really, really well, and the illustrations look beautiful. Hi, I'm John Stevenson, the Guaranteed Retirement Guy. Today we're going to be talking about how to take $100,000 and grow it to $26 million. So is it possible to grow $100,000 to $26 million in a fixed index annuity? Absolutely, anything's possible. And I'm going to show you on my computer screen exactly how it can be possible and which annuity carrier will do it for you. Okay, so if we're looking at top growth annuities, okay, we've got Atlantic Coast, we got Security Benefit, Allianz. Let's just look at the top one, Atlantic Coast B++. So if I go in here and I look at the illustration, we'll see $100,000 going into here. And then of course, with decent growth rate with the Credit Suisse, actually after, let's see here, 30 years, it's $26,544,000. That's pretty phenomenal. And of course, if you look at the credit interest rate, you'll see the credit interest rate is 80%, 118%. Boy, that looks juicy, doesn't it? And of course, it's all using the 3-year Credit Suisse, and they're basically what they're doing is they're just measuring it, and they're giving you a huge participation rate of 550% to give you that. Is that too good to be true? Well, usually if something sounds too good to be true, it usually is. But unfortunately, there are a lot of agents out there who will try to sell you this, make this nice big commission. Here's what you can really expect from a decent fixed index annuity, have some decent growth. I mean, 26 million is absolutely possible. I'll show you why this is projected to 26 million. Check out my screen. You notice that we don't have any 1-year allocations in here, okay? They're not measuring a 1 year, even though they have some decent ones in here. You got the 1-year S&P with a cap of 11.5. That's pretty good. They got some decent 2-year. They got the same indexes, Credit Suisse and S&P variations. And then we go to the 3-year. The 3-year, the reason why you see 100% of the premium is in there is because they're giving you 550%, which means if the Credit Suisse does 10%, they're going to give you 55%. The problem, of course, with that is participation rates change all the time. Insurance companies are buying option contracts associated with these indexes, and the cost for those options fluctuate a lot. And so sometimes they're really, really expensive, and you'll buy half of the amount of options that you got the prior period. Unfortunately, agents will use these illustrations to sell these policies. Now, here's what I like to do. I'll go up here and say, you know, Mr. Client, that looks all fine and dandy, but let's take a look at the 1-year S&P. That's kind of more of a conservative estimate because guess what? We're all used to seeing the S&P rise on a normal pace, and we know that if we get a certain amount of growth from the S&P, it's going to translate into growth into our annuity contract if we are following the S&P. So it's very cut and dry. And of course, when they're giving us such a large, generous cap of 11.5, that's not too bad either. So we'll take a look at that. And of course, the S&P has done very, very well over the last 3 decades. So based off of that, over that same 30-year period, that $100,000 will grow to $695,000 with an 11.5 cap. Now, that is assuming that the cap never changes because again, the insurance company is buying options, okay? And of course, with the S&P fluctuating so much and with so much volatility, the cost of those options also change. So because of that, the caps will change as well. This is a decent example. For sure, this is definitely more of a recommended illustration to show a client versus the other one. And unfortunately, there are agents out there that will show the other illustrations and say, hey, look, $100,000, you're gonna be a multimillionaire in just a few short years. And of course, we all wish that were true, right? But here, I'm gonna actually show you what I would recommend. If you're looking for a lot of growth from a fixed index annuity, then take a look at this because I think this is gonna interest you more. So first off, we're gonna go in here and say, all right, well, we don't wanna measure a 3-year. Why wouldn't I want to measure a 3-year? Well, think of it this way. If you've got huge growth for the next 2 years, things are looking really, really good. You know, oh man, at the end of that 3 years, I'm gonna have a huge credit to my account. But let's say the 3rd year, the market drops through the floor and you lose all of that growth that you got in the first 2 years. Now, all of a sudden at the end of 3 years, you've got zero, nothing. Versus a 1-year crediting strategy, you could have gotten interest credited to your account in the 1st year, the 2nd year, And then of course the third year when the market drops, you didn't make anything, but you didn't lose anything, and you retained all of your first and second year earnings in your account. That's what I recommend. And so going back to this, I'm going to show you. So if we go down here and say, all right, well, I want to measure the S&P 500. It's easy to follow. There's a lot of interesting indexes, a lot of fancy indexes, and a lot of new indexes that they backtest. But the S&P, well, we know what that's done for the last 100 years. It's averaged 8%. And then the last 30 years, it's averaged 10. So that's a very, very good average. So we're going to take a look at that and say, all right, well, the reset periods, we also want to be annual, okay? We want to be able to earn interest every single year and have as many compounding periods as possible, all right? So I'm going to show you the top one, and just putting in the S&P 500 and putting in the annual resets, you'll notice the average over 20 years is an 8.68% with security benefit. Now that's pretty decent. So I'll go in here and say, okay, what does that actually look like? Actually, you know what? That's not giving me any type of illustration. I want to actually illustrate it. So let's look at this one. Look at that, 1.132. Now that's pretty decent. Absolutely, I love that. Now, here's the thing though. We are paying a fee so we can have a higher participation rate in the S&P. And of course, right now, they're giving us a 100% participation rate in the index. That's pretty huge. They are charging us for that. And of course, you can see during the years where there's zeros, okay, those are the down years, okay? Those are the years where you don't make any money, but you don't lose any money either. So if everything stayed the same and the participation rate stayed at 100% and you continue to pay that 0.95% spread fee, then yes, your account would be at the end of 30 years worth $1,132,000. So that's pretty significant. That is definitely more of a possibility than the other illustration that I was showing you in the beginning. But here's another thing you need to think about. What if the participation rate changes, right? Even with the fee, what if the participation goes lower, or what if they throw this out and they give you other options and they're not as good? Those are all things to consider. And so I'll go in here and say, all right, well, this is pretty decent. I definitely would, these would be one of the top contenders that I would recommend. Another one is Life of the Southwest. And the only reason why I say them is because they're owned by National Life Group and they've been around for 175 years. And they have a long history of keeping caps and participation rates high. So I really, really like their products. Okay. And of course, you can see the average here is an average of 9.21% for 20 years. So I've worked a lot with Life of the Southwest, and they are an excellent, excellent choice for growth. Okay, so I'm going to go down a little bit more and say, all right, well, we got all these options. What else can I do? Well, let's go in here and we'll say, all right, rate guarantees. Can I get any rate lock-in? Let's take a look at that. Because, I've talked about things changing, right? What's the highest one that I can lock in? Well, right now, Delaware Life actually would give me a 7-year lock and a cap of 8.85% for the, what is it? It's the S&P, yeah. So S&P, so yeah, they're giving me a cap of 8.85, so 20 years average is 6%, and they're giving me a 7-year lock on that, which means they're never going to lower that cap below that 8.85. So if the index says 8.85 every single year or above it, they're going to give you 8.85. So it's very cut and dry. So I do like that. But, there are years where the S&P has done way, way more than that. And then you got years where the S&P hasn't delivered anything. And so that's why it kind of brings your average down over those 20 years. Okay, so, that's not bad. And I do like the idea of having some sort of lock on the cap, knowing that they absolutely cannot change it contractually. So I do like that because then I know what I have to look forward to and I know what I can count on. So, but here's another one that I like, and I want to show you this. Okay, so with Allianz, A+ rated company, they are the largest annuity company in the world. They got $3 trillion in assets. They've got a long history of growth, and they got very, very decent indexes right now. But if we're looking for growth that we can actually lock in over the course of the year, Allianz is a leader in this. So it's a little different than locking in a cap or locking in a participation rate for a particular index. Okay, that's great. And you know that it's never going to change. It's never going to go below that. Okay, but for this, what I want you to actually see the difference in is the fact that with Allianz, okay, they have an index lock, not a rate lock, but an index lock. So what does that mean? Well, basically what it means is they're putting you into an index, and you can see the top one here is the 1-year Morgan Stanley. And it's averaged 10.41% over the last 20 years. That's pretty darn good. So the nice thing about an index lock, and I have clients that will buy annuities with Allianz, and it's pretty cool because we'll actually get emails from Allianz every few months, and they're saying, hey, your account balance or your growth rate is like at 5% or 6% or 6.5%. Do you want to lock it in right now? You want to lock it in? Do you want to lock it in right now and lock in all of your earnings instead of waiting to the end of the 12-month period and where we measure the entire index and we'll give you whatever it's earned? The nice thing about that is if it's had a nice run up and you're worried about it having a run down before the end of the 12-month period, you can just lock in your growth right there and they'll credit to your account. So that's pretty nice. All right, so let's look at this. And it does have an allocation fee of almost 1%. So keep that in mind. But if I look at the hypothetical growth, well, it's pretty decent. Over 30 years, 100,000 grows to $1.9 million. So that's pretty decent. But again, that is based off of you never exercising the lock. The problem is you also are missing out on other earnings that could potentially do. And so what this is measuring in is it's measuring in all of the earnings during the entire 12-month point-to-point period. Okay, so you have to be a little disciplined and kind of leave it alone, or you have to be happy with making less, but also being able to have the flexibility of being able to lock in gains at any time. And it's pretty nice. It gives you that flexibility, whereas other annuities, they're just measuring a point to a point, and whatever it is, that's what you get at the end of it. With this, Allianz gives you the choice to lock it in earlier. Anyway, so I wanted to talk about this. I thought it was kind of a fun subject saying, oh yeah, $100,000 to $26 million. There's a lot of agents out there that will kind of blow up numbers for clients. And so I kind of wanted to start out that way and talk about that because yeah, there are annuities that can do really, really well. And the illustrations look beautiful. You've got high caps, high participation rates. And I just call those teaser rates for the stupid. Really, anyone who believes them is not being wise, okay? They're buying something based off of these hypotheticals that are blown up, and they're expecting to beat the stock market. And annuities don't beat the stock market. They just don't, okay? You're getting something definitely tangible when the market is growing. You're having growth and interest credited to your account. But when the market is down, the insurance company, they're not exercising those options, okay? And so they have to eat the cost of those options because they didn't exercise them. So in order to be able to stay solvent, they also have to cut the amount of profit that you get when the market goes up. That's why they'll give you a certain participation rate and a certain cap so that they make a profit on that covers their costs when the market is down and they cannot exercise those options. So there's give and take with annuities. They're great. You definitely get portions of the growth of the market, but you don't get all of it. And of course, in return, you don't get to participate in any of the losses. Okay, so it's a very nice trade-off when you're thinking about safe money investment. You want to protect, but you also want to maximize your gains. So if you're looking for an annuity and you're looking for growth and you're looking to work with someone who's going to show you everything, that's me. Book a call. There's a link below this video and we'll talk about all of your annuity questions. It all depends on what you're looking for. It doesn't matter to me. I sell growth, I sell income annuities, and I sell hybrids, I sell MYGAs, and I can help you with whatever you're looking for. So I really appreciate you watching. If you've enjoyed this video, I hope you like it, hope you subscribe, hope you share it. And if you've got questions, I hope you will leave a few comments below. I'd be happy to answer them. And of course, if you're looking to purchase an annuity with me, I'd love to work with you. So book a call. I won't bite. I'm not going to try to sell you anything, but I would certainly love to help you. So again, thanks for watching, and we'll see you in the next video. Hey, I really appreciate you watching the video today. If any of it makes sense to you, or if you found value, or if you even got a question about anything, there's no stupid question, and I'm looking forward to hearing from you.